Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. For our final segment of the show, we're talking about some common investor mistakes and what you can do to prevent them to become a better investor. If you missed the first couple segments, head on over to our website, which is www.dlblain.com. And there in a week or so, you'll find an archived copy of the show so you can kind of catch up. So we're talking about the first one. We wanted people to focus on the intrinsic value of an investment and not necessarily the price quoted. And maybe a better example is, your house. So let's say you live in a house. It has intrinsic value to you. Provides you shelter, warmth in the winter, and a place to live. Place to prepare your food. It has value to you. And just because the housing crisis, if you weren't planning to move or sell, the price quoted by the marketplace is really immaterial. It has value to you. It's a place to raise your family. It's a place to come home from work, watch TV, do your hobbies, whatever. It has intrinsic value in and of itself, no matter what a person is willing to pay you for it. Well, same thing with investments, whether it's a bond or a stock. Its value is based on the cash flows that it can generate for you over the years. And if you're dealing with the individual stock level, yes, they can go out of business. In fact, I was reading something the other day, as much as we've been hammering on mutual funds, during the financial crisis, something like 25% of the stocks on the market lost 75% or more of their value. I mean, that's just an amazing number. Out of the 8,000 mutual funds out there, only 6 lost more than 75% of their value, and I don't know what they were doing. But there's much more risk involved with individual securities. Anyway, I don't get off on that. So markets have an intrinsic value to them, and as Benjamin Graham famously opined that he viewed the markets as a weighing machine that always wins out, that eventually the intrinsic value of a company will be recognized and it will either rise to its intrinsic value, or if it's overvalued, it will fall to its intrinsic value. And Mr. Market on a daily basis is like a voting machine, and the prices are very volatile. So we want to encourage you to ignore the stock price movements on their own and focus more on the actual intrinsic value, the cash flows that investment may produce. Okay. Probably the worst mistake that investors make is trying to time the market. It's the biggest reason that people underperform, biggest reason people miss out. Now, of course, the examples of people, well, I got out of the market and I missed the financial crisis. You're going to hear that. Those are the stories you hear. You don't hear about the story, well, I got out of the market in 2008 and I'm still out today and I've missed, the 200% run up in the market or whatever it's been in. But everybody hopes to get in markets low and get out when they're high, whether it's individual stocks or markets as a whole. But there's nobody that anybody has identified that can do this with any consistency over long periods of time. It's a fact. There may be people selling timing systems. You may have read about this guy whose brother-in-law's sister's cousin did it, but there's nobody that has proven reliably be able to do it over long periods of time. It's a fact. Most investors who try to time end up actually buying high and selling low. Now, I'm not saying just ignore the signals that the marketplace is providing. So, for example, at the depths of the financial crisis in 2009 was a great time to buy. And I think short of a global financial collapse, if you had any sort of fortitude, you realize that prices were very cheap and it could be a very profitable time to buy. Likewise, back in 2000, if you were investing back then, things were really kind of crazy. And, people had this sense that things were overvalued and the internet was a little bit overhyped. And so they do give, at the extremes, I'm not saying you should be all in or all out, but at the extremes, sometimes it can be beneficial to either add to your portfolio or take take some profits off the table. But the majority of the time, the other 98% of the time, the signals that the market gives off, whether it be the bond market or the stock market, are very ambiguous. Perfect example, back in March and April, we saw yields on the 10-year Treasury go from 1.6 up to 3. And I said, don't panic. They're not going to go straight up to 9%. And sure enough, they've come back down. Yesterday, I think they briefly were hitting back in the 2.5 range. And so the valuation signals of the stock market, the bond market, inflation, they're much more ambiguous most of the time. And trying to use that to time your investments it's just not going to work out very well on a regular basis. So anybody that tries to convince you that they have some magic formula for timing the market, just hold on to your wallet. The same thing drives me crazy when I hear people talking about guaranteed income. Yes, you may have some sort of guarantee of income, but what are you giving up? Just ask seniors on Social Security. Yeah, they have a guaranteed Social Security income, but it's guaranteed to make them broke is about all. So stay away from people that profess to be able to time the market, and stay away from people that profess that they have some guaranteed annuity that's going to guarantee your financial security for the rest of your life. Maybe that's kind of off topic. Another mistake I see people make all the time is basing decisions based on emotion rather than reason. This kind of goes in hand with market timing, is the fear and greed. You hear Warren Buffett talk about this all the time. People get fearful when they should be greedy, and people get greedy when they should really be fearful. And in fact, they've done studies on the most successful investment managers, and their brains actually work different than most people. It's almost like this, Frankenstein experiment where that part of their brain, that emotional part of their brain, is almost sort of numb, and they don't get emotional. They don't have these fear and greed swings, which is what enables them to do a good job of managing money. And the final point, we're running out of time here, but the final point is to think probabilistically. What is the probability of the entire world collapsing, tomorrow? Well, it's not very high, and if it does happen, your investments aren't going to matter anyway. So we generally exclude that scenario because it's going to come down to, raising food and things like that. If you think that's a scenario, then this stuff doesn't matter. Well, that's all the time we have for today's show. I hope you enjoyed it. So for All Things Money, I'm your host, David Blain, and we'll be back again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.